Before we get started with today's episode, please note that when we use the terms safe, safety, or safe money in today's discussion, we're referring generally to strategies designed to help manage risk, not any product or investment that is guaranteed or free from loss or any other risks. All investments involve risk, including possible loss of principal. While some products may offer a level of protection against market losses, they may involve numerous other risks, such as interest rate risk, liquidity risk, inflation risk, credit risk, and more. Listeners should consider their own financial situation and consult a qualified professional before making any financial decisions. Now, let's get to the show.
Hi, this is David Dickens, and today we are going to talk about bonds. Since they have been dead in the water for about 10 or 12 years at zero interest rates, all of a sudden we have positive interest rates. So we want to explore, are bonds back, and should you have more of them in your portfolio? I'll go get Walter, and we'll get started.
Looking forward to another great episode of Cover Your Assets KC. I'm Walter Stroholt alongside David Dickens, President and Wealth Advisor of Creative One Advisors Group. And you can find us online at the website, creativeoneadvisorsgroup.com. David, great to chat with you this week, my friend. How is life?
Life is pretty good. It's pretty boring right now. Just kind of, living the dream of being a financial advisor and a grandpa and hopefully a pretty good husband.
Nice. That's good.
Anything new in your world?
Well, let's see. We have, we have a baby on the way, I think, as we revealed a few episodes ago. So
You're closing in on that, too.
We're closing in. We are less than 3 weeks from the due date. So, wow. I guess it could technically be any day.
Well, that is going to really change your life, Walter, I'll assure you. It's kind of funny. I'm looking at my calendar right now, and today is my lovely second daughter's birthday. So,
oh, nice. Very
good.
I
should have remembered that right off the top. So she occasionally listens to these podcasts. So if you happen to be listening, happy birthday.
Yeah, that's wonderful. And very exciting that, we've got a lot of things happening this fall. Normally I love fall because it's football and the holidays are rolling in and the crispness in the air, and this is just going to add another exciting reason to this.
Closing down that last month of pregnancy, boy, it's...
I'm going to tell you something. It flipped, like in a day, it flipped. Because she was doing pretty darn good through the whole pregnancy. Like, really, are you even pregnant? And she's very healthy, works out 4 days a week. She's still... even 3 weeks out from delivery, running on the treadmill. So, she's still a slow jog or run, but it's jogging or running, and it's pretty amazing. But yeah, there was something that happened. She definitely dropped, carried lower all of a sudden out of nowhere. Woke up one morning and I was like, whoa, you look really different. Something just shifted from up high to down low. That's a big change. And she also got very irritable.
Oh, she got more like you.
Yeah, there you go. So she's definitely had a little bit of a shorter fuse and a little bit less patience. And so, yeah, it's just I was like, okay, this last month, it's going to get real. So
that irritability, it totally goes away after your kid leaves the house for college.
Yes. So just wait about 18 years. And then
exactly.
We'll be good. I love it. I'm prepared, and I'm not saying anything that I didn't talk to her about. So she knows I rag on her a little bit, so it's okay. I'm being supportive in other ways.
I bet you are.
Well, let's dive into our bond talk before I get into any more trouble and dig that hole any deeper. But part of the inspiration of this conversation, David, came from an article, which we'll link down in the show notes just in case somebody wants to read it and check it out where these quotes came from that we're going to go through. And the article was all about bonds and kind of talking to different financial advisors across the country or people in the financial industry, just a little bit about kind of what their perspectives were on bonds and their role right now, and is there opportunity or are there things to be wary of? And part of the inspiration is, I don't know, you read some of these quotes, Dave, and it's like I'm picturing the average investor, maybe even your average client, reading this article and going, huh? And trying to make sense of some of it. So I'm hoping we can kind of just illustrate that on today's episode, but then also get your thoughts on bonds, where they stand right now, and where we're heading. Does that all sound pretty good to you?
That all sounds pretty good to me. We'll give it a roll and see. Hopefully our listeners are less confused by the end of this episode.
That's always the goal of every
That's the
episode,
goal.
right? Even if we cause some of the confusion, that's the goal by the end, that we clear it back up. All right, so this first comment came from U.S. Bank, was kind of the one cited here. To understand why opportunity exists in bonds in the second half of 2025, it's important to remember where bond returns come from. A bond can deliver a return to its owner from two sources: interest payments known as coupons, whose rate is set at the time of the bond is issued, and changes in the price of the bond as it trades in the market. So everybody tried to absorb that there, a little education of where income from bonds comes from. Can you break down for us, David, a little bit of that, but also why there's some general misunderstood nomenclature and knowledge about bonds, and what investors miss when they think bonds are just kind of this boring area of the financial world?
Yeah, so I get a lot of confused looks when we start talking about bonds in my office with clients. So I usually break it down like, well, first of all, your question brought up the phrase boring income. So if you're an investor, what you really want out of your bond or your fixed income investment is boring income.
Okay, that's the goal.
But it's the goal. You don't want drama with your bonds. You have drama with your stocks. If you're a trader, what you want is price volatility. You want the price to move all over up and down because you've made a bet on which way it might be going. So my first 25 years in the investment business was all in bonds, 100% bonds. So hopefully I understand bonds way better than the vast majority of people I talk to. With my first 2 weeks in the bond business, I learned an acronym that sums up the three key attributes of bonds. It was the SLY principle, S-L-Y, safety, liquidity, and yield. In a fixed income environment, if you're an individual investor, you probably are familiar with CDs, maybe fixed annuities, and perhaps bonds. The only one of those three that's truly liquid are bonds. So that's the reason the yield may be the same on the other two types of instruments. But if you want liquidity, if you want the ability to sell it before it matures, you're probably going to want a bond. So that's liquidity. Let's go to safety. The analogy with safety is all you're doing with your bond investments is you're making a loan to someone. And everybody in America understands what a loan is because we all have them on our mortgages, on our homes. So let's just say you have two friends that want to borrow money from you. In the bond world, that would be a U.S. Treasury or a corporation. But it's easier to understand if you got two friends. One is a party guy, not much savings, pretty much spends what comes into his checking account. The other guy that wants to borrow, each of them want to borrow $100,000 from you because you've done pretty well and you've got a couple $100,000 you could loan to some friends. The other guy budgets, saves like crazy, plans out his financial life, and you're sitting there thinking, well, at what interest rate would I loan to each of these guys? Well, the party boy, you're probably going to want a higher interest rate from him because there's a lower probability that you're going to get repaid in full and on time. But the guy that is super financially savvy, who knows why he needs the $100,000, but you have a very high level of confidence that he's going to pay you back in full on time. So that's credit risk. What do I think the probability of timely repayment is? If there's more risk, you're going to charge a higher rate. That would be a junk bond. If there's a lower risk of not getting repaid, you're going to charge a lower rate, and that's an investment grade bond or a treasury bond. So that's a quickie little on liquidity risk and on credit risk. Everybody understands those two. The third piece is what trips people up with bonds, and that's interest rate risk. So I want to take credit risk out of it. I'm going to talk about treasury notes because treasury notes and bills and bonds are considered to be, as much as we make fun of our government, they're considered to be the best credit risk on the globe. So if you buy a 6-month treasury bill right now, you're going to get 3.8% annualized, so half of that for that 6-month period. If you buy a 30-year treasury bond, you're going to get 4.6%. Not quite 1 percentage point higher of interest, but you have to hold it for 30 years before you get all your money back. So what constitutes interest rate risk between those two? Because the 30-year bond has way more interest rate risk. They both have the same credit risk, But the 30-year has way more interest rate risk than the 6-month bill, and here's why. It's probably intuitive, but if you buy a 6-month Treasury bill, do you really care what happens to interest rates over the next 3, 6 months, a year, 2 years, 5 years? No, because in 6 months, you're going to get your principal back and you're going to be paid interest. And it really doesn't matter what happened to interest rates over that 6-month period because your time horizon of getting repaid is very short. But if you lock your money up for 30 years in a Treasury bond at 4.6%, will you really care what happens to interest rates over the next year, 2, 5, 10 years, 15 years? And that is usually tied with inflation. So I'm going to try to quantify why that interest rate risk is really important to investors and how you can make money on them or you can lose money on them. These bonds, they're very liquid, so they're sellable, but at what price are they sellable? And that determines whether you have a gain or a loss. From a high level, a 30-year bond right now yields 4.6%. 3 years ago, they yielded 3.6%. 5 years ago, they yielded below 1.5%. They were 1.4%. That's a dramatic rise in interest rates over 5 years. All of our listeners probably remember Silicon Valley Bank. They went belly up largely because 5 years ago they invested in long-term treasuries when the Fed was saying interest rates are going to be lower for longer. And they took them at their word. Well, interest rates rose a lot, and the bonds that they owned went down in value significantly. How much do they go down significantly? So I'm going to try to quantify interest rate risk right now. Very few of our listeners would ever buy a 30-year bond, but you might buy a 10-year bond. 5 years ago, you bought a 10-year bond. So 5 years ago, 10-year bonds were a 1.25%. Today, that 10-year bond only has 5 years left to maturity. So if you were to go and buy a 5-year bond today, instead of the 1.25% which you bought 5 years ago, it's currently yielding 3.6%. So rates have gone up on bonds. The problem is you need to sell that bond today. It doesn't matter why, but you'd kind of like to get your money back instead of waiting the 5 more years before your 10-year bond matures. But nobody's going to pay you 100 cents on the dollar for a bond that only yields 1.25% when they can go buy a brand new one at 3.6%. So there has to be a mechanism that makes a current buyer indifferent between whether they're buying your old bond or a brand new bond. And that mechanism is all math. So what you're going to do is do a present value calculation, which I'm not going to drag you through, but you want to make that buyer indifferent between the new 3.6% bond and your old dumpy 1.25% bond. And so that present value calculation, let's say that these bonds are each $100,000. Nobody's going to pay you $100,000 for a bond that only yields 1.25%. But through this rather complex calculation, if they offer you $88,000 for your $100,000 bond, that's going to make them indifferent between whether they get that 3.6% coupon annually. A coupon is an interest payment. So at $88,000 for your $100,000 bond, they're going to be indifferent between whether they're getting a 3.6% yield or a 1.25% yield. It's all going to equal out because they're going to have a $12,000 gain when that bond matures in 5 years. They paid $88,000 for it. They're going to get $100,000 at maturity. They're going to have a $12,000 gain. So, but what you did on your 10-year bond 5 years ago is you just took a 12% loss on your safe Treasury note. And the only reason you lost that money, you know the Treasury is going to pay you back $100,000 5 years from now. You can't wait. You need your money now. And in order to make it all equal, you have to take a loss. And the loss is strictly from interest rate risk.
Makes a lot of sense. I understand. I see how the roles are reversed. It's almost like we're the bank giving out the mortgages, collecting interest, in terms of how some of those coupons and payments are working back in our direction. But interesting how that interest rate risk can make what's supposed to be kind of this boring and simple investment all of a sudden have this risk that can cause you to lose money. So that's why we've got to still be careful around these things. And it kind of leads us into our next quote. Speaking of being careful, This was from Financial Advisor magazine. But ignore the market for 30-year bonds at your peril. Interesting way to start out. Pension funds may be playing an important role by reducing demand now, but they are also awakening markets from decades-long cognitive dissonance. Wrap your brain around that one. There are reasons to worry, not only that rates aren't going back down, but that they may rise even higher. And I know there's probably a lot of debate in that prognostication at the end of that statement. So I don't know, with warnings like that, how do you put that into context for us? And also, I'm curious, just to add on to this, who should own more bonds right now? And does your advice ever shift? Because I know you often talk to young people on the show in addition to the retirees and pre-retirees that you work with. Does the advice shift if you're 40 or 60 or already retired or somewhere in between?
So that's a terrific question. I thought the quote out of Financial Advisor magazine was a little twisted.
Yeah,
but
I agree.
But to understand that, if you're an investor, you are much more interested in something like a 6-month or 1-year treasury bill or a 2-year, 3-year, 5-year treasury note. You shouldn't have any reason as a retired or nearly retired investor to even dream about owning a 10-year, 15, 20, 30-year bond because there's way too much. You're making a bet on your outlook for inflation. You have very high interest rate risk, even if you're not taking any credit risk. And as we demonstrated in the last discussion, you don't have liquidity risk because there's a mechanism to make the bond liquid. And that mechanism is you take a loss if rates have risen, you have a gain if rates have fallen. So investors do not want volatility most times. They just want the interest income. And that's why their safe haven, their parking place for their low risk money should be, let's just say 6 months to 2 years, maybe out to 5 years. Traders, on the other hand, they want that volatility. They can get volatility in a couple different ways. They can do interest rate risk by taking on longer duration or longer maturity investments. They can also buy junk bonds. Junk bonds, there is a credit risk component where you might not get your money back in full. Hopefully you get some of it, 50 cents on the dollar, 20 cents on the dollar. But as a trader, there are a couple of different ways to make money or lose money in bonds. So you said, well, depending on the age of the person you're advising, are you likely to do something different at 40 or 50 or 60 or already retired? Definitely. And this, what I'm getting ready to say, is absolutely positively not specific advice for you, our podcast listener. But if you're in your 30s or 40s, you have almost, as long as you have a reasonably high risk tolerance, you have almost no use for bonds. Because what you're really trying to do is you have a very long time horizon. So the stocks that you invest in, the stock markets that you invest in, may go down 6 months from now or 2 years from now. But by the time you retire 20 or 30 years from now, they are incredibly likely to be higher or much higher. But if you're retired, what you're really wanting to make sure, a lot of times what we do is set up a bucketing strategy where we have a bucket of short-term money, where maybe as much as 3 years of short-term money, where this retiree knows that they go get their monthly money, their monthly retirement paycheck out of the short-term bucket. They don't need to care what the stock market is doing, or for that matter, interest rates and their interest rate risk is doing, because they're getting money out of a short-term bucket of money, usually almost always fixed income money. It's a great example of the SLY principle, safety, liquidity, yield. It's very liquid. It has very little credit risk, and it has very little interest rate risk. So that's how the first thing is understanding who the person is that you're talking to across the desk from you. Are they high risk tolerant or low risk tolerant? And that will determine a lot of their bond allocation. But typically, the younger you are, the less bonds you have, the older you are, you want more in safety and liquidity.
That's one of the reasons why you hear that. Okay, that's helpful and helps kind of bring things home and make it all easier to understand why there's that sort of older saying of, as you get older, transition from stocks to bonds. And at least that's why it's not the other way around, right?
Exactly.
That's
right.
Okay. Last kind of quote here from these articles. This one was from Fidelity. If you're looking for income from individual bonds, current yields near multi-decade highs in longer-term bonds can offer an opportunity. And if you're considering bond funds or ETFs to diversify your portfolio, Fidelity's bond managers believe that a combination of high current yields and interest rates that are expected to gradually fall later this year is creating an attractive total return opportunity for bond investors in the months ahead. So given that takeaway, when you're building a balanced portfolio for a client today, David, how big a slice do these bonds deserve, and what are some of the other factors that you weigh before setting a percentage and including them in a portfolio?
So before I answer that, the quote from Fidelity mentioned a term called an attractive total return opportunity.
Yeah.
And all that means is total return is going to have two components here. How much interest you earn every 6 months on the bond, and are you going to have a capital gain because interest rates have fallen, or a capital loss because interest rates have risen. And the combination of interest and capital gain or loss is your total return over the holding period for that bond. Hopefully that's pretty understandable. So your question was, how do you determine, well, what is the right balance? It used to be that a 60-40 portfolio, 60% stock, 40% bond, was kind of the normal for a retiree. Then, after the great financial crisis, interest rates went to basically zero. Well, if you had 40% of your portfolio at zero, well, your chances of running out of money during your retirement just went up a lot. There's something called the rule of 100 in my business. And it was created a long time ago when interest rates were higher than they are today. We kind of feel like interest rates are high today. But, so when did I start this business? I've been in this business for more than 40 years.
I was going to say, cap it, David. Don't go too high.
I've seen interest rates short-term interest rates at 18%, and I've seen them at zero. So today's rates are not high rates. They're high from what we've seen over the last 15 years. So to get back, the rule of 100 says 100 minus your age is the amount of money that you should have at risk. So if you're 80, the rule of 100 says 100 minus 80, you should only have 20% of your money at risk and 80% in some sort of safe fixed income investment. If you're 30 years old, 100 minus 30, you should have 70% of your money invested aggressively and 30% in something that is safe, like a relatively short-term bond. So back when bonds were yielding 5 to 8%, that made a lot more sense than when they're yielding 3 to 5%. Bonds do, I think, deserve a position in a portfolio of people in their nearing retirement or in retirement. The question of how much depends on a couple things. How much are you going to rely on that portfolio for your retirement income, and what's your risk tolerance personally? So I have clients that do not rely one bit on their IRAs, their saved up monies, because their Social Security and their spouse's Social Security and their pension, it covers what they spend. And then they just have to worry about those pesky required distributions when they turn 73. And then they're a little bit concerned about the volatility in their portfolio, but not so much. But I have other clients that absolutely take money out of these accounts every month to live on, and they really care about the volatility of their stock portfolio holdings and their bond portfolio holdings. So as a general rule, anything fixed income, CD, fixed annuity, bond, anywhere between 1 day and 3 years, I would consider that to be kind of safe haven money. Rates go up from here. Well, your 3-year, if you need to sell it, is going to be worth less than you paid for it, but not a bunch less. Anything, I'm going to call it 7 to 30 years, all you're doing there, assuming you're in a high quality bond, you're placing a bet that interest rates are going to fall. Let me repeat that. 7 to 30 years, you're placing a bet that interest rates are going to fall. And if they rise, you're going to lose money on a mark-to-market basis. Your total return is very likely to be negative on a longer bond if rates rise. Somewhere in these three questions was the image of right now the Fed is lowering interest rates. But it's pretty interesting. as the only interest rate that the Fed controls is the overnight rate. Between one day, they don't control the 3 month, 6 month. They can influence 2 years, 3 years, 5 years, 30 years, but they don't. The only rate that they set is the overnight rate. And so, as the Fed is lowering interest rates, what the market is trying to do is figure out, as they're lowering interest rates into a pretty good economy, is that going to cause inflation to stay the same or go higher? And if it does, long-term interest rates are not going to come down with short-term interest rates. Long-term interest rates are going to stay the same or go higher. So your bet on falling rates and making a capital gain, just because the Fed is reducing rates, may end up doing exactly the opposite for you. So I bet, Walter, we don't have a single person that listens to this podcast that trades bonds. I mean, we might, but the vast majority of our listeners are bond investors. And they kind of hold their nose when they have to invest in a bond because they hope it's really boring, nice fixed rate, the money's there when they need it. But that's what you want as an investor in your late 50s, 60s, 70s, and 80s. That's what you want out of your bonds. That's why you keep them high quality, short term, very liquid. You've got your risk on the other side in what you do with your stock investments. Or maybe your $100,000 loan to your friend that is the party boy and not much savings, as we started the conversation with. What percentage of bonds you have in your portfolio is highly dependent upon how much you're going to need to use the money in that portfolio and how soon you're going to need it.
Really helpful, David. And if I understand nothing else out of today's show, not saying that that's the case, but if I understand nothing else, it's just that last little point about, okay, bond investor versus bond trader, like viewing those two approaches as very different things and different motivations, and thus just that one dynamic totally changes the entire conversation with somebody about something like bonds. Like, that's a really helpful perspective. I'm sure we could apply that same kind of perspective to other things in the financial world too, stocks and other things like that. So that's really helpful, just to understand that we don't have to view the conversation about bonds or anything in the financial world through one lens. Once you are kind of like in the right category, then we can work even further to give customized guidance and advice and recommendations based on your situation. But just right there, you have two divergent paths right at the top of the funnel. And so that was a good takeaway, at least for me, from today's episode, because I never really thought bonds through that lens before. So that's really helpful. Thank you.
Yeah,
for
it's
that.
like there are so many investment types out there.
Yeah.
And most of them are not right for you or you or you. But there's a combination of things that are right for you, and it's understanding what you're trying to get your money to do for you. And hopefully, you're either a really good do-it-yourselfer or you have an advisor who clearly understands what you are trying to get your money to do for you. And then they can direct you into allocations that 2, 5, 7, 10, 20 years from now, you can look back and go, okay, that was pretty good.
Yeah. I like to DIY stuff quite a bit, but when I read some of these quotes, David, I'll admit I immediately was like adapted to one of those folks that was like, nah, never mind. I'm going to hire somebody for this.
Well, the good news is, Walter, at your age, I don't know much about your risk tolerance, but you probably have a low, your emergency fund would be in, something fixed income, probably a bank product. But your retirement accounts might not have much of an allocation to fixed income. But I think it's really important to understand so that when the time comes, you have an understanding of how much allocation you should have.
My first thought was, I'm glad I get to talk to David about this one-on-one. And that's what our listeners can do as well. If you need help with your finances, and especially as it comes to planning for retirement and pulling all these things together. We were laser focused kind of on the bond conversation today, but that's just one slice of the pie. There's taxes, there's investments, there's income planning, and so much more involved in putting together a true strategy to get to and through retirement. It's what David and his team at Creative One Advisors Group are doing each and every day. So if you want to reach out and have a conversation about where you stand right now, where you're trying to get to, what your goals are, and how to accomplish them, David and his team can walk you through that conversation. It all starts with a complete planning review. David calls it the CPR process, to take that close look at your specific specific situation. If you'd like to set up a time to chat about that, all you have to do is call 913-317-1414 or go to creativeoneadvisorsgroup.com. And we've got contact information in the description of today's show to make that easy as possible on you. David, thanks for the great guidance on bonds today. Enjoyed the conversation with you, and we'll talk again soon.
Yeah, you've got 3 weeks to go before baby arrives, so we will be very flexible as to when we have our next conversation.
Yeah, folks, if we don't have one in 2 weeks like the normal schedule, you may know the reason. But we'll make it up for you on the backside. So.
We will.
Good stuff. Thanks, David, and thanks, everybody. We'll see you next time right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth LLC, a registered investment advisor, Creative One Securities LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.